So I was chuckling to myself when you talked about this as a roller coaster. The analogy I would use is a bungee jump,
Yep.
because it has that vertical drop and that intense reversal. The cord caught and then pulled. It feels like it's almost pulled the market back up. And that to me is important. It says to me that behind the scenes of a market that is, at or near all-time highs, there's a level of anxiety that shows up in incredibly impulsive and emotional behavior. This is a crowd that doesn't stick around. It moves and asks questions later.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's expert, behavioral economist Peter Atwater, adjunct professor at William and Mary College, has long affirmed that changes in confidence consistently and predictably impact investor preferences, decisions, and actions. Well, there's certainly been a lot happening so far this year to both spike and crash investor confidence. It's been one heck of a sentiment roller coaster so far, with little signs that things will calm down anytime soon. So, what are likely to be the biggest drivers of confidence from here, and what are his key indicators telling him about the prospects for the rest of 2025? Well, we'll ask the man himself. Peter, thank you so much for joining us today.
Great to be here, Adam. Thank you.
Thank you. Well, Peter, I should start with an apology that it has been far too long since your last appearance on this channel, so I'm glad we're rectifying that now. I'd also like just to acknowledge, I think, a really nice bit of praise that you got recently. I was interviewing Jesse Felder, who both a friend, friend of both of ours, but also just one of the more thoughtful, smarter people I have the pleasure of interviewing, and he really took his time to pause and call out your work as one of the top influences on him. And I thought that was, I think a well-deserved, well-earned honor, but a good honor as well.
Yeah, it was very humbling. I'm a huge fan of Jesse and his work, and to hear him talk about the confidence map and how that's been helpful to him, um, yeah, that's tremendous praise, and
Well,
just very humbling.
and just to be clear too, I hear praise from you, not just from Jesse, but from other folks I interview as well. In fact, I just got finished interviewing Stephanie Pomboy a few hours ago and mentioned to her that I was going to be talking with you, and she said, "Please give Peter my best," and again reiterated what a big influence you've been on her.
And a huge fan of Steph's as well.
All right, well,
Very
it's
fun.
a mutual appreciation
Uh,
society here at Thoughtful Money. All right, well, look, let's dive right in, and I guess, let's just start from a high level. Um, On a score of 1 to 10 for volatility, how does 2025 score so far, confidence-wise?
so I was chuckling to myself when you talked about this as a roller coaster. The analogy I would use is a bungee jump,
Yep.
because it has that vertical drop and that intense reversal. The cord caught and then pulled. It feels like it's almost pulled the market back up. And that to me is important. It says to me that behind the scenes of a market that is, at or near all-time highs, there's a level of anxiety that shows up in incredibly impulsive and emotional behavior. This is a crowd that doesn't stick around. It moves and asks questions later.
Yeah, and this is sort of one of the things I was talking about with Stephanie earlier. The market really does sort of seem to have kind of this bipolar nature. There doesn't seem to be much sort of in the middle. There doesn't seem to be much of a Goldilocks from a sentiment standpoint. It is either things are going to hell in a handbasket right now, or the future's so bright I got to wear shades. Does that tell us something? I mean, does history sort of tell us when you get to a market that is that sort of schizophrenic? Does that say where we are anywhere on the story?
Yeah, I think of this not as risk off, risk on, but risk in and risk out.
Hmm.
So to your point, there's no middle. It's all in, all gas pedal, or all brake. And that says to me a couple of things. One, it brings back market memories of the 1960s, where you had markets that moved like a yo-yo, but really didn't go anywhere. So again, volatile people creating volatile times, volatile markets. But it also speaks to me about sort of this passenger seat environment with investors. One of the things that I notice a lot is that this is a group of people that have become very complacent in the passenger seat, whether that was with allowing the Fed to drive, or fiscal policymakers to drive, or even post the election, allowing President Trump to drive. And the passenger seat, which I write about in my book, is an environment where we have certainty but no control. And you can think about it like an airplane. Everything feels great until we're all praying because we're afraid the plane is going to crash.
Mm-hmm.
And I think that it's that backdrop of not uncertainty that gets all the attention, but the inherent powerlessness that investors feel today, that CEOs that I talk to feel today, and that feeling that I'm either going to be a incredible beneficiary or a absolutely obliterated victim of decision making of others.
So you said several things here that I think is really interesting. So to the extent that what we're seeing now is similar to the 1960s, lots of volatility, but at the end of the day, you don't really go anywhere. Um, we've had a lot of people on this channel recently who have made sort of similar assessments about 2025 at least, and perhaps maybe even a longer stretch than that ahead. But of course, their message is the passive investing strategy worked really well over the past decade plus. That's probably not going to work nearly as well in that type of environment, and therefore you want to adopt more of an active investing strategy, which a lot of these people are sort of positioning as a return to the way that investing used to be, where you had to do your homework, you had to try to identify the good companies, separate the wheat from the chaff, and try to invest in those companies. Where everybody's been so conditioned now to just buy the general market or buy the index and just hold, buy the dips, and know that the Fed, uh, fiscal spending, the new president have your back, right? And when you talked about this sort of passenger seat mentality of investors and CEOs and whatnot, it's not a huge surprise after so much time of artificial intervention in the markets that you learn to stop fighting it, and you just learn to go with the flow, right? That not a huge surprise. So in many ways, this is somewhat a self-inflicted situation we find ourselves in, and it's maybe a poor analogy, but I recall hearing a comment from a Russia expert where somebody was talking to them about, post-fall of the Berlin Wall, would Russia eventually, adopt capitalism once it got a real taste of it? And their saying was, well, if you understand Russian history, the Russian people just kind of always want a czar. There's just something in their culture where they just kind of expect that there's going to be some strong man to tell them what to do, whether it's a czar or whether it's a modern version like a Putin, right? And I wonder if we've created this environment for so long in the markets that the average Western investor is just looking for somebody to drive the bus, as long as the bus goes up over time more than it goes down.
Yeah, and I see this particularly in the post 9/11 generation. If we think about what happened in the world of parenting post 9/11, it became about keeping kids safe. And so anything that was viewed to be uncertain became perceived as unsafe. And so you had lots of parent involvement. We talk about tiger moms and helicopter and
Yep.
bulldozing parents. But this is a generation that has been led to, they have been happy followers. Somebody else has fought the battles for them. And I think that that transcends so much American behavior right now.
Mhm.
That this is a group that would happily, stew in the passenger seat rather than get in the launch pad. The idea that they would take control is anathema to many of them. They don't know how, they have no experience leading. You, I suspect, like me, we're raised as kids, I was told go outside and play and don't come back till dinner.
Yeah, the era of really kind of benign parental neglect. Yeah.
Yeah, but with that, we learned how to manage, take control in uncertainty. And yes, the outcomes weren't always wonderful, but we learned from them. We developed scars and bruised. We learned about courage and responsibility and lots of important things that in for many people today have been postponed into their lives.
So let me dig into that for a second. I think that's really important. So you're the behavioral economist. I'm not. So this is my armchair version. Please correct what elements of it might be wrong. Um, but raising this post 9/11 generation the way that you described, we've taught them that safety matters most, and we've taught them that they should seek safe spaces, and set the expectation that they should expect to have a safe space, right? Which really doesn't map to real reality, right? And so, using this from an investor mindset, um, yeah, you want to have an environment where the markets are just steadily going up over time because of intervention, right? And that's what you expect. When the worm turns market-wise, these people are sort of the least prepared to deal with the shift in markets. So in other words, you're potentially setting up this younger generation of investors for extreme disappointment if their expectations are set on being taken care of by kind of the market gods and expecting to have safety where, you know, in a volatile world, the safety is not a guarantee.
No, and discomfort is the norm. One thing that really bothers me is that this sense of any discomfort is being translated as a lack of safety. That we're going to have an uncomfortable conversation. I'm going to raise a viewpoint that's counter to yours,
And then I'm
and
going to cancel you, Peter, just so you know.
and so my backlash is extreme as opposed to let's have this conversation, and respect each other and learn from each other as opposed to fleeing from that possibility. I mean, I think our echo chambers in terms of media consumption are a reflection of our
Yep.
unwillingness to introduce uncertainty into our lives.
So I want to get to what does it look like in a world where people conditioned to safety and certainty suddenly don't have it? What are the implications you expect from that? But real quick, if I can do just a quick tangent, because you're the perfect guy to clarify this with. Um, what I had heard was this actually started before 9/11. I think 9/11 was a real catalyst in kind of solidifying the supremacy of safety. But what I had heard was that there was a shift in the mid 90s, that if you ask people who were born, I think the year was before 1996, what's your first memory of being out in the world by yourself without your parents, literally exploring the world? Um, and the average, I think, was around 5 to 7 years old. Oh, I used to get to walk to my grandma's on my own, or I could walk to school on my own, or I could go out and play until the streetlights came on and then I had to come home type of deal, right? And if you ask people born after 1996, it's more like 12 to 15 years old. And what changed, at least initially, was they attribute it to the advent of 24/7 cable news. So there was news on all the time and airtime that had to be filled. And then it was the abduction of Polly Klaas and I think one or two other children that were abducted. And that was all over the airways in these new 24/7 news channels. And it put the fear in the mind of American parents, oh my gosh, that could happen to my kid. And so parents got a lot more clingy or hovering. And then, of course, 9/11 really amped up that stuff. And the societal impact of that was to your point, when you're a young kid and you're out in the world exploring it on your own, you deal with adversity, you learn how to overcome it, you're inventing and playing games with your friends, and you have disagreements and you learn how to work through them. So by the time you get to college, um, you know, you can know how to handle interpersonal disagreements, and it's just all part of life, and you're pretty facile with that. Whereas if you don't get started until your teens, you don't have enough time. So by the time you get to college, and I'm curious about the college part because you're a professor, by the time you get to college, you still don't know how to process that stuff well. And so when you have disagreements or adversity with others, you interpret it more as like you're reacting lower on your cerebral base, brainstem, and you're taking it more like an existential threat on you, and so you react like to a physical threat, and you want to cancel people, and you demand, I've got to be protected from this, right? So, A, is what I'm saying, is there any real grounding in that? And B, what are you observing living in the academic sphere?
Yeah, so two thoughts that came to mind. One is think about the minivan and what the minivan of the 1990s was intended to do. I mean, we were shuttling kids back and forth and around that, we needed these vehicles to move lots of kids at once to from one location to the next. So your point about protecting them is to me real, so you can see the cultural response.
Hmm.
At the other end, the college end, what fascinates me most, Adam, is that again, I feel like the man who was raised in black and white TV. But one of the things when I talk to my peers about the college experience is our parents dropped us off, and at best we might see them at fall break, maybe Thanksgiving. In my case, I didn't see my parents till Christmas because they were overseas. But you burned the ships. The ships were
Yeah.
burned. And that requirement to be there and to know that you had to make it work there is something that this generation doesn't have in their life. They know that they can move, they can transfer, they can call old friends, they can flee from their current space easier than any generation before them. They have mobility that was unavailable. And as a result, they never are forced to bloom where they're planted. And I think that has huge implications to community and service to others and being part of something that is intimate and physical in terms of your relationships. And that goes away because I don't have to make it work.
So super fascinating. So, okay, so if that's how the younger generations have been raised, and by younger generations, we're really talking millennials, Gen Z, Gen Alpha, et cetera, right? Um, with Gen X as maybe the transition generation, and the boomers being purely grew up in black and white TV, at least initially. Um, what does that lead you to expect for society? I mean, I'll bring it back to investing, but like,
Yeah.
what are the implications? I'm sure I can invent some negatives. Are there some positives? Is it more corrosive than it is beneficial? What are you looking at?
So I look at the volume of individuals who feel today trapped in the passenger seat, who realize that, or they're coming to realize that they have sacrificed control for certainty
Hmm.
and that they find that really unsatisfying.
Sorry to interrupt, but I mean, it harkens back to the old quote attributed to Benjamin Franklin, right? Those who would prioritize security over liberty deserve neither.
Yeah,
Yeah, they're waking up and realizing, hey, I've made a trade-off that actually isn't serving my long-term interest here.
right. And has left me ill-equipped to be an entrepreneur, to be an inventor, to be a true creator, because they have been raised to be passive. And I see this particularly frustrating to young men
Yep.
who feel this need to be in control. And on the one hand, we could say that this is bad, but on the other hand, I am looking forward to those moments where this next generation concludes it's time to take control.
Hmm.
And I'm excited to see what they do and the direction that they take things, and the sense of inherent community and responsibility that will come with that. This is a generation that has never had to demonstrate courage or sacrifice. They have been raised in an environment of abundance, not just of stuff, but of safety. And so they're going to have to confront scarcity and a need for priority and issues of sacrifice that I think will form the basis for what comes after this turmoil that we are within. I mean, I think there's a real generational transfer that is underway behind the scenes. You know, we have an old guard in both Republican and Democrat politics that are likely to be surprised by a new generation coming to the fore.
Okay. I'm hearing a lot of echoes of Neil Howe, sort of in what you're saying with his fourth turning. And I'm sort of fresh off interviewing Neil from like a week or week and a half ago. So what I hear you saying, Peter, is there's a lot of underutilized human potential, if you will, in the younger generations right now because they're sort of stuck in the passenger seat. But just as Neil would say, in a classic fourth turning, the pressures keep building as the status quo starts to fail, but they eventually become so intense that it's almost like the heat that then gets hot enough to create a chemical reaction, right? To break the bonds, let new molecules form. And that'll be transformational for these generations. And I get the sense, don't let me put words in your mouth, but that you're not saying these are lost generations, that's it. These are never going to be useful, uh, age cohorts. They're going to sort of have a great awakening at some point here. And that may then unlock a lot more human potential where they start getting out of the passenger seat and into the driver's seat.
Yeah, one of the things that, again, all of the media would lead you to believe that the issue today is uncertainty. I don't believe that. I believe the issue that is lingering is a sense of powerlessness. And what I know looking at social movements is that you can have all the uncertainty in the world, but it is the addition of powerlessness that creates the spark. So if we think about Occupy Wall Street, we think about Black Lives Matter, we think about the spontaneous events that take place. It's an issue of a demand to take control, even if it's wrong. That I
Mhm.
have to do something in response to what I'm feeling.
It's sorry to interrupt, but I'd love for you to riff on this. I mean, you're making me think of the American Revolution, where the colonists, they thought of themselves as British, but they just kept getting insult after insult, stamp acts and all sorts of other things that
Yeah.
just kept increasing to the point where they felt like we have no other choice but to do this. And we know that like if we do this and we lose, we're going to get steamrolled by the most powerful army in the world. But our backs are against the proverbial wall here where we now have to lean into this.
Yeah, and for the young, they have nothing to lose.
Right.
I mean, they look at I mean, you look at the wealth divide, which is something that as you know, I've been writing about for a long time. I get frustrated because the media would lead us to believe that the conflict is left or right. I believe the conflict is in terms of economic and wealth terms, up
Hmm.
and down. And what I see for those at the bottom is an immense weight of vulnerability. They feel powerless and uncertain in so many dimensions at once. And that weight ultimately creates a tipping point where they will do something. And I have no doubt that the extraordinary wealth divide that exists today is going to come to an end, because those at the bottom will not allow it to continue in place.
Okay, and so very curious, what is your thinking on how that is likely to manifest? I can make an argument it might manifest in a way where financial prices crater, and therefore the rich just aren't as rich relatively as they were. And a good example might be, lots of boomers are really hoping to sell their McMansions at current market values, but most, millennials who are the natural buyers can't afford them. And so the boomers just might be forced to have to take some big haircut on that. The other way I could make an argument for it is millennials get into political power and it's confiscatory taxes, right? How do you think it's more likely to play out?
So I think you can look at all of those. I think, too, we need to recognize that shareholder primacy is a relatively modern, recent phenomenon. And this notion that in all instances the shareholder comes first, I can see the shareholder sacrificed. That shareholders are an easy symbol for those without to go up against. Whether you label it Wall Street, the rich, the shareholder class feels particularly vulnerable to me. Um, I also think that you have this question of technological change that could just as easily upend where value is. And so I don't know what the trigger is, but I think we're naive to think that the status quo, where the system bails out the shareholder at every turn, is sustainable.
Okay, and if that's your thinking, how material is it that the new president is using language like Wall Street's headed good for a long time, we're now going to prioritize Main Street over Wall Street?
So I think our current administration has a very challenging tightrope to walk, because it was elected by populist support, but is also incredibly beholden to the ultra wealthy. I mean, you look at who attended the inauguration, um, you know, the number of billionaires in the room and the cabinet. So this is a precarious position for an administration. And what I see is sort of this to and fro. 1 minute it's like the sort of the biblical story, loves the first, hates the second, loves the second, hates the first. But you see this tension where you have deliberate appeal to one group and victimization of the other, and then you switch to the other side. And I think that that's a tough act to keep going, to try and placate those that have diametrically divergent preferences, interests, wants in the outcome.
So, that said, do you see this as a progression? Meaning, looking at previous recent administrations, seems like they were pretty much on team capital, if you will. And now this one seems to at least be giving some lip service to labor as well. Maybe it's trying to thread the needle, maybe it might not be able to. But is that the natural progression you need to get to before you start seeing policies that are enacted that really prefer labor over capital? And I'm not saying necessarily the Trump administration is going to be the one to do that, but is this sort of the progression you would see on the way towards Main Street taking over from Wall Street?
I guess I look at administrations following Main Street as opposed to leading Main Street.
Hmm.
And so I look for tension to mount on the populist front that suggests that the winds have changed. And in some ways, you could look at the sacrificing of Elon Musk as an example of where the administration has chosen to sacrifice, one of the elite in order to placate those at the bottom. We'll see how this plays out. And just to be aware, this is not a uniquely American phenomenon. I did a presentation recently on what I call a few good men. We live in a unique moment in history where we have country after country being led by dominant, independent nationalist figures.
Right.
You know, you've got Erdogan in Turkey and in El Salvador, in China, in Israel, in India, in Hungary,
Hungary,
Romania.
Argentina. You've
Yeah,
seen the rise of Le Pen and AFD in
yeah.
Germany, even. Yeah.
And so
Maloney.
what I think is going to be important to watch is how do these individuals sustain their national support or quell their national nonconforming in an environment where ultimately they are in competition with each other. One of the things you were talking about earlier was diversifying by company. I think that the big challenge for investors today isn't diversifying by company, it's diversifying by country,
Hmm.
because you have independent leaders who are going to dictate policies. And I think you as an investor have to conclude, in this country, do I believe I will be a beneficiary or a victim? And even more importantly, do I think others think they will be
Right.
beneficiaries or victims? And that's decision making that most investors today have never had to contemplate. That when they've talked about emerging markets or frontier markets, it's been the concept of opportunity. They sort of overlook history where you had nationalist leaders who were not always kind to capital from abroad. And I think today we need to think about this holistically, globally. Okay, you choose you don't want to be in America, but where are you going to go otherwise? What is an environment where your American money is going to be warmly received and you will be a beneficiary and not a victim in that other country?
That is such a great point. And I'd like to dig into it a little bit more, but let me ask first, because you put your finger, I think, on a massive sea change that is in process, right? Which is, up until a year ago, ish, globalization was the playbook, right? And that really has it's getting swiftly dismantled worldwide, as you've said, right? And who knows what's going to happen, but I find it hard to feel like we're going to go back to it anytime soon, if at all. And I've had people on this channel who have really studied this, geopolitical history, who for many, many years have been saying, look, globalization is the exception, not the rule here. And we're just the pendulum swinging back to the way the world has pretty much always worked. So you could say that confidence in globalization has suddenly gone through an accelerated erosion. Um, Beyond some of the implications for investors you've mentioned, just how important is that?
It's hugely important because to me it's a reflection of deteriorating confidence. I talk about us everywhere forever as the mindset at peaks in confidence. And the idea that you could get anything from anywhere to anywhere overnight. I think of FedEx as really the embodiment
Hmm.
on a corporate perspective of this mindset of globalization. And so what we're doing is turning inward, as we always do as confidence falls. And we're discovering the fragility of a highly complex, interconnected system,
Hmm.
as we always do. So there are what we're revealing isn't to me anything new. It's these are the same things we saw in the mortgage world as confidence deteriorated there.
Yep.
You know, and what's the implications then, I think, have to be looked at in a couple of dimensions. And these are critical elements if you're running a business. The mobility of labor, goods, capital, and information. And I look at those as four variations on a single theme of confidence. I know that when confidence is high, all of those will be mobile at once, intensely mobile and frictionlessly. I know when confidence falls, all of them will be subject to barriers, walls, moats, impediments. And this is where I think if you're looking at the markets, you need to be looking at immigration policy. You need to be looking at trade policy, because ultimately that becomes capital policy.
Hmm.
And so, what does it mean as countries are balkanizing and creating impediments to the mobility of individuals and goods? I think it's only inevitable before we see that in the mobility of capital.
Okay. Um, so let's see here. So, you know, I guess let me go narrow first, then we'll go maybe wider again. So the new administration has been extremely disruptive. I think in many ways it has surprised its own supporters at times, right? So, for example, the way that the Liberation Day tariffs were rolled out, I think even surprised a lot of people that were sort of on Team Republican. Um, and so you could make the argument that that is further evidence of what we're talking about, which is countries all of a sudden uh, breaking away from norms and what's expected to do something that they think is in their extreme, self-interests. But also that you could just say, look, so far the new administration is just eroding confidence because people either don't like the direction things are going in, or it's just additional uncertainty. And when you're more uncertain, you have less confidence, right? Um, so I'd love to get your thoughts on that, but if I can, while you're answering that, Trump has thrown up a lot of dust in the air. He, at this point, though, has a lot of accomplishments that he can point to now and say, I got that done. I got that done. We're getting making progress on this, right? So there is becoming more certainty, even on the crazy trade side. Even since Liberation Day, we've had, prices have still largely come down. We haven't seen crazy inflation yet, at least. We've done the deal with the UK, China, which nobody thought was going to come to the table, and they were saying they weren't going to come to the table. We're now doing talks with them. Um, Trump's trip to Saudi Arabia, has a trillions worth of announced deals and commitments and buying a bunch of Boeing planes and all sorts of things, chips commitments, all that type of stuff. So, there's a whole long list, and I've mentioned it in a couple preceding videos here, where you can say he's removing uncertainty now from things. And of course, the markets have made up for all of their April losses. The S&P is now green on the year. Um, so, how do you see Trump as of right now in the new administration? Is it more disruptive change agent that is eroding confidence, or is it more uh, breaking some of the things that needed breaking, and it's now actually building momentum in a way that may increase confidence?
I think, Adam, that all of those are true. And I think that for some, the idea that you can hold something that is scalding hot in one hand and icy cold in another feels like being disingenuous. But I think it speaks to this tightrope of trying to satisfy one group and another group who have diametrically opposed wants. And so what he can do today is to demonstrate that he has satisfied both of them. At the same time, I think it's also fair for others to say that they have been immense beneficiaries, and others to say that they have been immense victims of what has happened. Both of that's all true too. And so I think that the challenge for folks in trying to create a singular story that he's all bad or all good is almost self-defeating, because you have to recognize that what he's trying to do is to satisfy both ends of the spectrum at once, and will create very visible, highly touted successes for both groups, so that when he walks in the room with one group or the other, he has the ability that you've just identified, that he can talk about his successes. And that is his nature, that is his want, and he has been given the ability to do that. The question for him, and he's not alone in having this question, is can you continue to do that? Does the crowd on either end allow that to continue in an environment that feels like red light, green light, where it's all gas pedal, all brake, all gas pedal, all brake? And some would suggest that it begins to feel like an abusive relationship, where one day you've come home with flowers, the next day you've come home and hit somebody backside the head. And so that exists in plain sight. And so I say, yes, he has been successful in delivering to both. The question will be, can he continue to do this in a way that maintains a sense of certainty and control?
Okay. I think you just described a pretty complicated situation in a very effectively simple way. So thank you. That actually helped me. Um, so then let's trundle into the so what part of the discussion, Peter, which is, okay, so you've kind of, I think, really effectively described the situation that we see ourselves in, and some of the things that investors need to care about more now than they didn't have to, up until now, pretty much. But for the lived experience of the average person and average investor going forward, what do you think is more probable? I kind of get the sense from what you've said so far is that things are going to continue to be volatile and rocky, and before we get to the optimistic part where the younger generations find their sense of purpose and we unlock all that potential, pressure is going to have to get greater, meaning pain is going to have to mount. And so it's probably not going to be a super fun journey in the short to midterm before some of those really transformative actions happen. So I don't want to put words in your mouth, but like, what should people kind of be mentally preparing for from here?
So I think investors need to be thinking about, are the companies and the locations that you are investing in, will they be beneficiaries or victims of the dominant national leaders where they're operating? And here I think it's going to be increasingly challenging for these trans global companies to satisfy not just two masters, but 12 masters at
Right.
once, each with competing demands. And again, their challenge is trying to placate individuals who have absolutely opposing goals and objectives. And so they too are now on a tightrope. As investors, you need to be thinking about things in terms of not gains or losses, but beneficiary or victim. That in every case, what I see is a binary outcome. You see folks winning in an extraordinarily enormous way one day, and others who are being brutalized the next. And we see this in price changes and just global sentiment. And I think you have to think about, if I'm owning a stock, what is the probability that my CEO ends up having a Zelensky moment in the White House? Because I think that in the not too distant future, we will see a CEO, just face a very confrontational president who wants to make clear that compliance is required.
Mm-hmm.
And again, these are he is not alone in that. I don't want anybody to think that I'm trying to single out, President Trump, good or bad. I just see him as one of many representative figures today.
Yeah, and that's consistent with Michael Every, who is one of the analysts who, for a long time, has been predicting this return to nationalism or mercantilism. And
I think of it almost as feudalism.
yeah,
These are feudal leaders.
so Michael has again was promoting this before it became as obvious as it's becoming now. But one of his things that he mentions, he says, look, in a mercantilist society, you could even say feudal society, but in a mercantilist society, the government is really, instead of just letting sort of free trade flourish, it is saying, look, we've got national priorities, some of them that might trump economic priorities. So in some cases, the economy is going to be subservient to a greater national priority. And to guide ourselves towards those national priorities, we may feed this part of the economy while intentionally starving, or we may intentionally starve this part of the economy to feed this part of the economy, right? And then that might shift next year as our strategic priorities change, right? So you kind of have to be willing to keep your eyes open for that. And that very similar to what you're talking about, like a Zelensky moment, you might get a kind of like what China did with Jack Ma.
Yeah.
You could see something happening here where Trump says, look, we're really trying to get, X manufacturing back up and running in the States here, and a big CEO that's standing in the way of that. Trump might say, hey, you know what? Just like he did to Harvard, right? Okay, well, we're going to revoke we're going to stop giving you grants. We're going to revoke your tax exempt status. If you're not playing ball with us, in key sector X, there might be some bad things that happen to your particular company. Your competitors who are playing ball with us might be just fine, but we may starve you out.
Yeah, I think people bristle when I talk about centrally planned government and economy, but this is going to be centrally dictated, so long as you have a independent nationalist leader. And this is where I talk about shareholder primacy. I believe is a myth today. That shareholder primacy is incompatible with the kind of political agendas that I see around the globe.
All right, so that's really super interesting. Does that in any way then make you feel a little more like, okay, then stay invested in the markets. You're not telling people get out of the stock market entirely, but you're giving them more dimensions that they've got to pay attention to. But does it also make you kind of think like, and therefore you might want to hold some of your wealth in assets that are less susceptible to this? So gold might be an example, right? It's a physical form of wealth that you can hold, and unless the government tracks you down and tries to forcibly take it from you, it's yours, right? Or real estate or other types of assets as well. But I'm just curious, does it inform your thinking that way at all in terms of assets to own in a full portfolio?
Yeah, it makes me think about geographic diversification.
Mm-hmm.
It makes me think about assets that have utility value as opposed to investment value, because I know that as confidence falls, utility matters more than potential return. And so as our time horizons shrink, what matters changes. It's, ramen noodles are currency in most jails today.
Mhm.
So you need to be thinking about what has utility value, what will ongoing have utility value, and do you own that? Um, and I think that as you are evaluating your investments, if you're going to be a shareholder today, you have to filter them through political risk screens first. That political risk, rather than being the fourth or fifth element of an investment decision, is now the first element. How will this fare with Mr. Modi? How would this fare with Mr. Erdogan? How would this fare with Mr. Trump? Because
Y-
those those individuals are going to determine your fate.
It's so interesting. You're making me realize you're connecting a dot here for me. I have found myself talking about politics way more in the past 4 to 6 months than I had in the past several years, on this channel. And um, it's not because I've wanted to. It's not like that was an intent or a priority. I'm just finding it's becoming increasingly hard to try to forecast where things are going in the economy without taking these political policy decisions into consideration. And so while I had this cognitive dissonance about like, why am I doing this if it's not really what I'm setting out to do? You're connecting the dot with me, which is because I have to do it. It's just we're entering a period where you have to take in the political winds much more than we've had to in the past.
Yeah, and I would say to those who are ardent Trump supporters, appreciate that he will make decisions where you will be both a beneficiary and a victim.
Hmm.
And I would say those who are Trump, opposing, there will be investments that are beneficiaries and victims. And to paint these dominant leaders as all good or all bad, as the media would like us to do, really distorts how people take risk today. You can see it where, if I talk to investment advisors, they joke about their red client portfolios and their blue client portfolios. It's like that's not a healthy approach, because as we've seen, these dominant figures are often mercurial. And so you have to be prepared for their mood swings.
Oh, that's really super useful. All right, well, Peter, look, is there anything kind of on the confidence spectrum that you look at closely that I haven't thought to ask you about yet that's worth putting on the radars of our viewers here?
Yeah, I think that investors today need to anticipate bungee jump like movements, because what I see is decision making that's no longer driven by value, but is driven by price. That it is the movement in price that is soliciting enormous entry or enormous exit.
Okay.
Folks are not being reflective. Very few folks today are taking the time to think about value and what's something worth. And I say that because I think investors need to appreciate that currencies themselves are where a lot of value gets hidden, get exposed, gets created, and gets destroyed. And so if we see, lots of discussion around the dollar collapsing in value,
Yeah.
well, you could see the S&P skyrocket in nominal terms in that. But the price and value will have become completely decoupled.
Hmm.
And I just encourage investors to step back sometimes to think about things in terms of value, you know, earnings multiples, cash flows, things that ultimately drive the success or failure of a company. The other last thing I'd leave you with, Adam, is to appreciate that in the world of currencies, it's a game of relative beauty. And so when I hear people saying the dollar is going to collapse, it's like, well, that would suggest then that the euro will rise in value, the yen, the yen, all these other currencies will appreciate in value. And that may or may not be the case. What the currency market helps us to see is what are the best and worst houses in a bad neighborhood today. And so I encourage folks to pay attention to the currency market because they're really giving us a read of how does global sentiment feel about one country versus another.
Versus another. Yeah. All right. Well, look, how does history tell us? So if people are not investing based off of value, and I agree, they haven't in large part, painting with a broad brush here, but they haven't in large part for a good long while. If you look at how elevated valuation metrics have become, really over the past decade plus, but at the start of this year, we were, well, things cooled off a little. Now they've heated back up, but I mean, we had almost every valuation metric that you could point at, we were either near all-time extremes or at the all-time extreme, right? And there's a meme that's been circulating over the past year or so on social media saying, this is the single best investment decision you can make. And it's a picture of somebody tossing Benjamin Graham's Intelligent Investor into the trash, right? Kind of meaning like the old rules don't apply anymore,
Yeah.
right? So what does history tell us when we fly the market plane, not by valuation metrics, but by price metrics? I mean, I'm assuming they don't end up well, but you correct me if I'm wrong.
They don't end up well. And ultimately, what markets bottom on is immediate tangible utility value.
Mm-hmm.
So the time horizon is today. The hypotheticality of it all is very small. It's, is this useful or not? Is it useful to me here right now? And so I encourage folks to think about having in their portfolios things that would have immense utility value in a crisis. We watched with COVID as people were racing to Costco to to with their pallets of different
By the
things.
base fundamentals, my toilet paper, yeah,
Yeah,
like bags of rice,
yeah,
yeah.
and what that was telling to me is, oh, these are the things that have immediate tangible utility value.
Yeah.
And I'm not saying, fill your house with toilet paper. What I'm saying is that if you're going to invest through a crisis successfully, those companies that provide those goods are much better standing and a much more stable foundation than, some sort of meme coin.
Okay. So, I mean, to my mind, this is sort of things like consumer staples. It's probably even like utilities, it's commodities or commodity producers, just essentials that the world needs, not quite so much the high flying growth stocks or consumer discretionary or things like that. Am I thinking about this the right way?
Yeah, needs not wants.
Okay. All right. Well, Peter, look, I'm looking at the time. We're up here at the hour. I could go an awful lot longer for you if we had the opportunity, but I've got to be respectful of your time. It's always super fascinating to talk to you. I'm going to ask in just a second where people can follow you and your work, but I do just want to re-mention from my discussion with Jesse, your book, The Confidence Map. When Jesse was recommending it, it was prominently right there on the bookshelf behind him. It's actually over your shoulder right there. Yep. So where can
Shameless.
people who are really interested in your whole construct of looking at the world through the lens of confidence, where can they buy your book? Anywhere books are sold?
Anywhere books are sold, Amazon, Barnes and Noble. Support your local independent bookstore, please. Um, yeah, and I think what what gives me the greatest satisfaction with my book is that people read it particularly investors, thinking it's a book on economics or investing in confidence. And then they'll talk about with me the life experiences that it's helped them to better understand. I had a hedge fund manager who, his eyes welled up as he was talking about his wife's experience with cancer and how
Hmm.
the framework, powerlessness and uncertainty helped him to better organize the journey that they had been on. So it's a book on decision making that uses economic and investment examples, but it's to me it's all about decision making.
Well, that is great and obviously well deserved from all the work you put into the book. In some ways, I mean, I find the field of behavioral economics so fascinating for a whole variety of reasons. One, because we think economics should be so easy to understand because it's so quantifiable, and then the human equation just makes it all totally irrational in many ways. So we need these frameworks to think it through. But I also I put it in the same category as Robert Cialdini's influence, which you're nodding vigorously here. Um, it's you read it and then it really does change the way in which you look at the world. You can see the world differently, and in many ways, you're better armed to deal with what the world throws your way because you actually now have a framework to understand it and react to it. So, anyways, great work on that book. For folks who can who would like to follow you and your work in between now and the next time you come on this program, Peter, where should they go?
So they can find me on X, on Blue Sky, on LinkedIn. I write in different voices for those different environments. I also write commentary through Financial Insights, which is my consulting firm, where I try and use the framework that I write about in real time, you know, where sentiment matters in the markets.
All right, fantastic. And Peter, when I edit this, I will put up the links to your handles there and your website on the screen so folks know where to go. Folks, those links will be in the description below this video as well. All right, well, look, Peter, hang on just 1 second. I want to do just 30 seconds of housekeeping, and then I want to give you the last word. Folks, if you've enjoyed having Peter on this interview, even half as much as I have, please let him know by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And if you would like to get some professional help in navigating this future ahead, which I think is fair to say Peter thinks is going to be fairly volatile for a good while, and maybe have some increased pain ahead of it before we start climbing into some better future, then highly recommend that you leverage the expertise of a good professional financial advisor. Importantly, one that understands and takes into account the issues that Peter has discussed for us here. If you've got a good one who meets those criteria, great, stick with them. But if you don't, or you just like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just fill out the short form at thoughtfulmoney.com. Only takes a couple seconds to fill out the form. These consultations are totally free. You get personalized, bespoke advice from these advisors after they've sat down with you and learned about your specific personal situation. And there's no commitment to work with them. It's just a public service they offer to be as helpful as they can. All right, Peter, thanks for your patience. So the folks watching this video, in large part, yes, we do have some professional investors, but most of them are just regular people who have been working hard to build some wealth to provide for their family's financial future. And I'm guessing many of them feel a little discomfited by the increase in uncertainty and volatility of this year. Um, what would your advice be to them, for the ones that I think their core fear is just things are getting so uncertain that I'm afraid the odds are getting higher that I'm just going to become collateral damage to these forces, and my wealth's not going to make it to the other side when I need it.
So one of the things, because of all of the volatility that I say a lot these days, is that it is important to plan for what you can imagine and be prepared for what you can't. It troubles me to see investors who are all in or all out. And that leaves them exposed to what they can't imagine happening. And I think this is an environment where tempering the want to be risk in or risk out is really important. The future is inherently unknown. And what changes isn't the future, it's us and our feelings. And when we feel things are uncertain, that's really on us. And that's a statement of our level of confidence. And so I encourage individuals to listen to your stories because they are a function of your level of confidence. And we need to be careful not to get seduced by them because they will be most seductive, most, absolutely affirming at extremes in confidence. And that is where we ultimately make our worst decisions, good and bad.
I just want to underscore what you're saying, twofold. One, you are right, and I talk with many, experienced financial advisors on this channel about how, as investors, it is most frequently our own emotions that are our biggest enemy towards our investing success. That when we make emotionally based decisions, they tend more likely to be the wrong choice at the wrong time, right? So A, that, but B, hearing this from you, Peter, who is, one of the most widely respected behavioral economists out there, is it's not just an opinion that you're slinging. This is your life's work in studying how human emotion impacts investing decisions. And just one thing you said, it's going to be when you feel most certain something's going to happen, is when you probably need to apply the greatest discount factor to that certainty.
Yeah, and I find myself plotting my own mood on the map, and that helps me to realize, okay, you're looking for trouble here.
Yeah.
And just
And just to make it actionable for folks, it doesn't mean, oh, I feel really certain about this, so therefore I should do the opposite. But it just means that don't go 100% all in, right? At least have some hedges in place, right? Okay, in case my plan A doesn't pan out, let's make sure I don't get totally destroyed and I've got some chips over here on a plan B. Or it's do plan A 100%, but only at 80%, right? Keep 20% of the portfolio away, right? So you're nodding as I'm saying all this, right?
yeah, I I'm a big believer in confidence diversification, that's ultimately what saves you as an investor. You should have in your portfolio something that is great, feels good, is doing really well, and then you should have something that would make others laugh. That you hold this thing that if you went on Twitter and said, I own this, the crowd would ridicule you because ultimately it is owning a mix of emotions that creates portfolio diversification. You don't ever want a pie that is all hot or all cold. I want pieces that are piping hot and are right out of the freezer cold because I know
So
that that's going to help me over time.
I totally understand the logic behind that, but I want to understand it a little bit better in the sense that you want to truly diversify, and I like this concept of using levels of confidence as a way to diversify. I'm real certain about this. This one I'm not that certain about, but I'm going to have some exposure to it anyways, right? But I don't necessarily get the sense you're saying, okay, put some chips on the thing you're most confident in, and then try to find the dumbest investment that you could find, right? So, for example, I don't, unless you want them to, I don't want them to take away, okay, let's say you're really into, the Mag 7. So you're going to go big Mag 7. But then you're going to go buy some fart coin just because it sounds like the dumbest thing you could think of.
No, I think it's more tempering your portfolio. Yeah, I mean, what the last several years have shown people is if you have a pie that is nothing but Mag 7, that pie has done extraordinarily well. But when that pie cools, the entire pie is going to cool.
Right.
And so I like to have things that are abstract because they'll do well when confidence rises. I like things that are tangible as well because I know they will do well when confidence falls.
Okay. I think that's a very helpful clarification, and I really I think, interesting and probably, quite successful way to look at how to diversify. Peter, thank you so much. This has just been wonderful. Best of luck in the interim. I'll continue looking at your work. Highly recommend folks go read your book. And I'll invite you back on in about a quarter or so, unless something happens in between that really materially changes your read of the confidence map. And if that does happen, I just want to make sure you understand the door is always open for you here at any time to come on and let us know, call an audible midstream if you see a big change like that.
I appreciate that, Adam. Thank you.
All right. So wonderful, Peter. Thank you. And everybody else, thanks so much for watching.
Saudi Arabia is now, to my mind, the third government next to China and Russia who are, or maybe let's call it the fourth, India, China, Russia, and Saudi Arabia now. And again, these are all, these are members, whether admitted or not. Saudi Arabia is, in essence, in my mind, pretty darn close to a BRICS member in that they are a full participant in the bridge technology. They are going to all of the BRICS meetings. They are very much have one foot in and one foot out to appease the West, but by all of their moves appear that they are going lockstep with the BRICS movement. They took a major stake in SLV, the silver ETF recently, and enough to demand physical delivery. Now, they haven't done it yet, but you have to have a certain amount, like it's a basket, huge amount, millions and millions and millions of dollars worth, in order to be able to demand physical delivery. This is a privilege retail investors do not have.
Saudi Arabia, while not yet a formal BRICS member despite invitations since 2023, is increasingly aligning with the bloc's strategies. Its central bank has quietly taken a large stake in the SLV silver ETF, big enough to allow physical delivery, a privilege unavailable to retail investors, signaling a growing shift toward precious metals. This move fits into Riyadh's broader strategy of diversifying ties with emerging economies under Vision 2030 while still maintaining Western alliances, highlighting a geopolitical pivot toward multipolar finance and alternative hedges in an uncertain global system. Andy Schectman, the CEO and president of Miles Franklin, reveals that COMEX deliveries and offtakes have surged to record levels. Countries like China, Russia, India, and now Saudi Arabia are heavily accumulating silver, signaling its strategic importance beyond just industrial use. Saudi Arabia even took a major stake in SLV, giving them the option to demand physical delivery, something retail investors can't do. Meanwhile, global accumulation is rising. China is buying directly from miners. India has purchased over 800 million ounces in 5 years, and Russia added silver to its national stockpile. Analysts warn that even a small shift of investment from gold into silver, say 10%, could consume all newly mined global supply, potentially triggering a massive squeeze. At the institutional level, interest is also growing. Harvard's endowment recently bought $101.5 million in GLD, reflecting how mainstream precious metals are becoming. Sovereign wealth funds, universities, and hedge funds are positioning for physical delivery, while the general public remains largely unaware of the unfolding shift. Before we continue our talk, please subscribe to our channel and click the bell symbol to receive timely updates. Have fun watching the video, and thank you.
Deliveries onto COMEX are extraordinary, Elijah, as are the offtakes off the COMEX exchange, which are extraordinary. These are very, very much aberrations. They're anomalies. We don't see them very often, or never have until recently. And I remember talking with your dad in 2020 about all of a sudden all of these deliveries coming into COMEX. They've only increased 100-fold. But when you talk about trends, Saudi Arabia is now, to my mind, the third government next to China and Russia who are, or maybe let's call it the fourth, India, China, Russia, and Saudi Arabia now. And again, these are all, these are members, whether admitted or not. Saudi Arabia is, in essence, in my mind, pretty darn close to a BRICS member in that they are a full participant in the bridge technology. They are going to all of the BRICS meetings. They are very much have one foot in and one foot out to appease the West, but by all of their moves appear that they are going lockstep with the BRICS movement. They took a major stake in SLV, the silver ETF recently, and enough to demand physical delivery. Now, they haven't done it yet, but you have to have a certain amount, like it's a basket, huge amount, millions and millions and millions of dollars worth, in order to be able to demand physical delivery. This is a privilege retail investors do not have. They will. I find it interesting. We've talked at length about China flying around the world and buying doré and concentrate directly from the miners in South America and Mexico. We've talked about India buying over 800 million ounces in the last 5 years. We've talked about Russia making it part of their national stockpile, which we'd never heard before from a government, and now Saudi Arabia is doing just that. And so when you realize that India, China, Saudi Arabia appear to be publicly accumulating silver under the guise of industrial uses, it's a lot more than industrial. Silver is really more strategic than it is industrial. Just a 10% shift from gold to silver, where all the people investing in gold, if 10% moved it to silver, it would consume all newly mined silver globally. This is, implying a potential massive squeeze. He said, 1 billionaire won't do it, but 10 would, or a 10% shift out of gold into silver. When you see governments like Saudi Arabia come into the fray, you know that it's coming. I found it very interesting. One of the things that I talk about a lot when we talk about the public not holding any gold, very little. My standard phrase I copy from Rick Rule. He says, from Joe and Jane six-pack to the Harvard Endowment Fund, the average of gold owned by the public and gold-related equities is 0.5%. Well, lo and behold, the Harvard Endowment Fund just bought $101.5 million in GLD recently. And so now you have all of these institutions jumping into accumulating precious metals. Now, these institutions, I don't know how much they understand the difference between GLD and the real thing, but you look at Bass, his last name is Bass, I forgot, his Kyle Bass, I think is his name, when he the Texas Teachers Union, or it was a big fund for that. I believe that's what it was. It was a long time ago, maybe a decade ago, but he put all that money, like $1 billion, into GLD, and they took possession of it as well. So I don't know if he intends to do this, or they intend to do this time, the Harvard Endowment Fund. But the very fact that they're buying $101.5 million in GLD tells you that gold and silver are becoming more mainstream, certainly more mainstream. And I think you'll see at this upper level on COMEX, sovereign wealth funds, endowments, that's one step away from the public, who is still kind of blissfully, whistling Dixie, not really understanding the significance of this. But the people who are very, very tied in to what's happening globally are making moves and standing for delivery.
Andy points out that insiders are leading the charge into commodities while dumping stocks. Hedge funds and big investors have been selling billions in equities weekly, with major figures like Buffett holding record cash, Nvidia executives unloading shares. Insiders selling far outweighs buying, while the public is heavily leveraged in stocks, options, and margin at record levels. At the same time, insiders are accumulating gold and silver, with record COMEX deliveries and the U.S. turning into a net importer. This contrast shows the public is all in on risky equities while insiders quietly shift into hard assets. Historically, insiders win because they have both money and information, positioning early before the masses catch on. We're nowhere near the top because the public hasn't really entered the gold and silver markets yet. Andy highlights that over $100 billion has been delivered on COMEX this year, much of it leaving the exchange, which signals insiders know something big is coming. With interest rates likely to fall, asset prices will rise, but average people without assets will be left behind. Hard assets like gold, silver, and even crypto look set to surge as the dollar weakens and commodities remain undervalued compared to financial assets. Insiders are positioning early because they see the stress building in the system.
Because the insiders, this is how markets work. The insiders always lead the charge. The insiders don't just have the most money. It's not luck. The insiders are also connected to the information. And that's the most important thing. And if you understood the information and you see the people who understand the information moving, in a certain direction, well, you should be doing that. I've talked at length over the last few weeks about the contrarian indicator. And let's just go over it once again for the chance that the few people watching this haven't heard me say this ad nauseum. And I apologize for those who have. But on one hand, you have the insiders dumping stocks, the hedge funds, the managed money has been selling between 2 and 4 billion a week since June. Buffett is sitting on between 4 and 500 billion in cash. You have a 7-to-1 insider selling to insider buying since the beginning of the year. You have the 3 or 4 largest board members of NVIDIA, huge stockholders selling cumulatively over $1 billion in NVIDIA shares. You have Bezos has sold over $6 billion in Amazon since June 1st. You got all of these insiders who have the information selling, right? At the same time, you have the public, which is all in the highest allocation to precious or to equities ever. More so than the great financial crisis and the dot-com bubble, about 54%. But if that wasn't bad enough, they have the largest allocation to margin play, the highest ever, over $1 trillion, and the largest allocation to options. So options and margin signal speculation and leverage. So you have the public all in on leverage and margin. At the same time, the insiders are leaving. But flip it over to the other side. You have the public, as you mentioned, very tepid in terms of their understanding or allocation to the commodities. But what do you have going on the other side? You have the largest deliveries on COMEX that we've ever seen, ever. And the U.S. has become net importers. Who's bringing all of that gold in? And much of it leaving the exchanges. Well, those are the insiders who are closest to the information. So the insiders are buying commodities and selling equities, and the mom-pop public is nowhere near commodities and all in on equities. What could possibly go wrong? And this is what I think people should take away, is that, this is why the big money always wins. They're positioned when no one else has any inclination. And by the time the people figure it out, the insiders have been comfortably positioned for a long time, and they're probably at that point start looking for their next great value that no one else is noticing. And this is why the rich get richer and the poor get poorer, because the rich not only have the most money, they're closest to the information. They know the playbook. Do what they're doing, not what conventional wisdom is saying. We're nowhere near the top because the public has no understanding of exactly what is happening. This has been driven by central banks primarily, and big money, and whoever is taking possession here in the United States. But the public is nowhere near even entered into this at all. So no, I think that, to see a market move the way that it has without the public involved is rather telling. To see what amounts to north of $100 billion delivered into the COMEX that we know of since the beginning of the year. What does that tell you? I mean, this has never happened before. And to see a lot of it leave the exchange, this has never happened before. And people at that level don't make moves like that unless they know something is coming. And I do believe that. I really do believe that. And so I guess I would say we're nowhere near the top. When you see, like, to your point, everybody talking about it, and everyone having allocation to it, well, it may be time to start thinking about this. But not only that, we're looking at lower interest rates coming, which of course benefit asset prices. And so this locks out average people as far as I'm concerned, because the average people, they don't own assets, and assets are what make the wealthy. Because, as they're going to choose a path of inflation, you're going to see everything pop up. You're going to see stocks, real estate, bonds, gold, silver. All of these things are going to surge, in my opinion, at least at first. Now, what happens with the stock market ultimately is anyone's guess. To see all the people, all the big money moving out, to me, is very dangerous. But I think you will see cryptos, precious metals, those things are going to do very, very, very well. Hard assets in particular. will do very well, because these are things that will protect you as your dollar is losing purchasing power. And, commodities right now are historically undervalued related to financial assets. So I would argue they're really the ones that are poised to break out. The system is under stress, Elijah, and it seems that to a degree reality is catching up. That's why the insiders are doing what they're doing. They do it long before the rest of us figure it out.
While the public remains largely unaware, central banks, sovereign wealth funds, and major institutions are quietly accumulating gold and silver, signaling a strategic shift away from risky equities and into hard assets. With record COMEX deliveries, growing BRICS alignment, and insiders positioning early, the stage may be set for a powerful move in precious metals. Those who wait until the mainstream catches on could find themselves locked out or paying much higher prices. Do you think the public will only recognize the shift into gold and silver after prices surge dramatically? Could silver face a historic supply squeeze if institutional demand continues accelerating? Please feel free to express your opinions in the comments section below. If you found this content useful, please remember to subscribe to remain updated and to give it a thumbs up.
Central banks are making out of U.S. dollars and out of U.S. treasuries into gold. And that has been the primary driver of the gold bull market. And gold has outperformed the S&P so far in the 21st century, 25 years. And this is going to accelerate. And not only is it going to accelerate among central banks, but institutional investors and retail investors are going to finally start to participate. So, a $10,000 gold price is not that far off. It's only about a triple from here. But I think it could easily be done over the next, maybe 3 to 5 years.
Central banks are set for a fourth straight year of heavy gold buying, with around 1,000 metric tons expected in 2025 as they shift away from dollar assets amid U.S. policy and geopolitical risks. In Q2 2025 alone, they bought 166 tons, 41% above normal levels, showing the urgency of this move. A World Gold Council survey found 95% of reserve managers expect gold holdings to rise in the next year, with 43% planning to add more, while many see the dollar's role declining over the next 5 years in favor of gold, the euro, and the yuan. Peter Schiff is a well-known economist, investor, and financial commentator, highlights that gold miners have surged over 50%, far outpacing bullion's 25% gain, with ETFs like GDX and GDXJ still trading at low valuations despite strong earnings growth. A Reuters poll sees gold averaging $3,220 in 2025 and $3,400 in 2026. Silver is up 32% this year, nearing $40, its highest in 14 years. He mentions that the S&P may be up about 10% this year, but with the dollar down the same amount, international investors see no real gains in U.S. stocks. In contrast, this performance gap signals a shift of capital away from the U.S., as both foreign and American investors redirect money abroad. Gold and silver mining stocks have been standout performers, up nearly 80% and on pace to possibly double this year, outperforming tech, crypto, and every other sector, yet largely ignored by mainstream media. Looking ahead, while developed markets like Europe and Asia have led in 2025, emerging markets remain undervalued and could be the big story of 2026. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
Well, look, the inflation is going to erode away most of the investment returns. Yeah, the S&P 500 is up 1.5% today, but the dollar's down 1%. So, it's really only 0.5% if you measure it in other currencies, and that's how investors around the world are looking at it. But meanwhile, foreign stocks are doing a lot better. Look at gold stocks, which, gold stocks are up another 2% on the day, but they're up 77% year to date. That's the GDX and GDXJ. So this is indicative of, the Fed being too loose. And, gold is up today, but it's still, below 3,400. Silver is now back above $39. But I think silver is getting ready to blow through 40. And I think gold's getting ready to blow through 3,500. Well, the economy is not booming, and nor is it going to boom at all during the Trump years. But in order to cure the problems that he inherited and that he contributed to during the 4 years he was president, right? He doesn't come to this thing with clean hands. But in order to fix the problems, we actually need a bust, right? We need the bust before we can have the boom. Trump wants to skip the bust and go right to the boom, which you can't do. All you can have is a bubble. So rather than have a legitimate economic boom, Trump just wants to inflate another bubble so he can pretend that the economy is booming, even though we're just blowing air into a bubble.
Yeah. And so you mentioned a bust. How bad could this bust look? Like how bad could it be?
Horrific. I mean, much worse than 2008. I mean, we have a huge debt bubble, and when it pops, there's a lot of disaster in its wake. I mean, there's going to be a lot of defaults, a lot of bankruptcies, a lot of failures. Look, stocks are going to crash, bonds are going to crash, real estate's going to crash. Look, a lot of bad, painful things have to happen to fix this problem. That's why the problem's not going to get fixed, because the politicians don't have any stomach for that pain, because it might mean that they don't get reelected. And of course, that's the only pain they care about is their own pain. And so they're going to kick the can down the road with another sugar high. And the Fed is now cooperating, cutting rates. By next year, they'll be in QE mode. Yeah, well, I think the S&P is maybe up around 10% this year, which is about how much the dollar is down. So if you're an international investor, you're looking at no return on U.S. stocks. Meanwhile, I look at my mutual funds. I have 5 mutual funds. One of my mutual funds is called the Euro-Pacific International Dividend Payers Fund. And we buy dividend-paying stocks outside the United States. So, higher dividend-paying stocks. So typically, these are more conservative type stocks. So they're not growth-oriented. We're buying them because they pay good dividends. Well, that fund, year to date, is almost up 40% now. 40%. Now, yeah, about 10% of that is foreign exchange related. But still, that is, a huge performance gap. I mean, basically, we're making 4 times the money investing in foreign stocks as we would be investing in the S&P. And that is a big signal to capital allocators around the world to jump on board this train. And so I think you're going to see a lot of money leaving the U.S. markets. Money that has been sucked into the U.S. markets for the past 10, 12 years is now going to get sucked out. And that means foreigners who have U.S. investments are going to sell their U.S. investments and bring their money home. But then Americans are going to sell their U.S. investments and send their money abroad. And so that's what's really going to be helping. I mean, my asset management company, Euro Pacific Asset Management, because that's what we specialize in. And again, gold stocks are up now close to 80% on the year, 77% for the GDX, GDXJ. This is the best year on pace that I can remember. I mean, there may have been a better year in the early 1970s, mid 1970s, but this, I think, is the biggest year, single calendar year that I can remember on pace. Because I think we could finish the year where the GDX and GDXJ, these are indexes, double in value, 100% gain in a single year. And gold stocks year to date are the best performing sector, gold and silver mining stocks in the U.S. stock market. They're beating tech, right? They're beating crypto. They're beating whatever. Like whatever you think is the best, it's not. It's gold and silver mining stocks. And they're getting no coverage. If you watch the mainstream financial media, you'd have no clue that these stocks were doing so well. We've been way overweight Europe. And we have investments in Southeast Asia, including Japan. And we have some money in South America and in Canada, But I think we're going to probably be allocating a little bit more into the emerging markets. We have an emerging market fund that concentrates. And the emerging market fund is my least performing fund. Year to date, it's up, in the low 20s, which is still beating the U.S. by double, more than double. But the emerging markets haven't done as well this year as the developed markets. I think that may change in 2026. So I think we're probably going to allocate a little bit more into the EM for next year, because I think that's going to be a big 2026 story, is going to be the outperformance of emerging markets. Because they're still really, really cheap compared to developed markets, and even cheaper compared to the U.S. market. Well, I think silver's looking pretty strong. We're just around $39. There's obviously some resistance up there. But if we can break through it, we're not quite at a 52-week high today. We didn't quite make the highs. But we'll see what happens next week. I know that these metals are basing, but silver is very cheap. And so I've been a real promoter recently, last 6 months in particular, even before, when it was 100 to 1, when you could get 100 ounces of silver for 1 ounce of gold. And, it's not quite that cheap anymore, but it's still historically cheap. So I really like silver.
U.S. assets currently dominate global portfolios, accounting for nearly half of the investable market. However, rising concerns over U.S. weakening dollar returns are prompting investors, particularly in Europe, Japan, Sweden, and Australia, to explore alternatives like gold, Chinese tech, and emerging markets. Risk hedging via currency strategies is gaining traction as the dollar's depreciation erodes dollar-denominated returns. Peter reveals that China still offers plenty of cheap stocks, and with growing weight in emerging market funds, it's positioned to come out of the global trade war stronger, forming deeper ties with Russia, India, Africa, and even Latin America, while U.S. influence weakens. Meanwhile, U.S. tariffs, like the 50% duty on Indian goods, ultimately hurt American consumers and strain foreign partnerships. Commodities are set for a major boom as inflation rises and the dollar weakens. Energy, oil, natural gas, and agriculture all look cheap now, but demand will surge, especially from emerging markets that benefit from a weaker dollar. Instead of exporting to the U.S., these nations will increasingly produce and consume goods domestically, driving up demand for energy and resources. While this supports global growth, it also means higher commodity prices for Americans, many of whom will be priced out due to the declining dollar.
And so
I think there's still a lot of cheap stocks in China. We have some Chinese exposure in our funds, and especially in our emerging market fund where we're overweight China. But yeah, I think that China is going to come out of this, global trade war as the winner. I think that they're going to strengthen their trading relationships with the rest of the world. They're going to form better alliances with Russia, with India. This is going to be to the detriment of the U.S. And I think they're going to have stronger relationships in Africa, and maybe even in our own back door in South America. You might see that the Chinese gaining additional inroads in Latin America because they're not going to be trading as much with the United States. It's not just that we shot ourselves in the foot. We're shooting ourselves in the head. Put 50% tariffs on India, 50%. Now, again, the tariffs aren't on India. They're on Americans who buy Indian goods. But it still is a problem for Indian companies that wanted to sell American goods because now their goods are 50% more expensive if the Americans want to buy them. Yeah, well, first of all, if countries stop buying oil from Russia, it's just going to make oil more expensive because if they have to buy it someplace else, you're just going to shift the demand and we're going to end up paying higher prices. Ultimately, Russia is going to sell the oil anyway. It's going to get it out of the country. So it doesn't make any sense to put those sanctions on. And all it does is piss off people. Like it gives people another reason to get out of the dollar and get out of U.S. treasuries. Countries don't like being sanctioned. They don't like being pushed around. We wouldn't like it either if some other country was doing it to us. America benefited from other countries using our currency. We got the seigniorage gain. We got artificially low interest rates too, and we got lower consumer prices. But we're pushing all that away. We're, biting the hands that have been feeding us. So it's generally not a good idea to do that. And they also, need to hedge against Bitcoin if they have some of that. That's the stupidity too, because a lot of people in America, instead of buying gold the way they're buying it in India or China, they've been buying fool's gold, aka Bitcoin. And that's been a problem because when the Bitcoin bubble pops, a lot of these people who thought they were buying something like gold, they're going to find out that they weren't. So that's unfortunate because Americans don't own enough gold, either because they own Bitcoin or they own nothing. But owning Bitcoin is basically like owning nothing because that's all you got when you own Bitcoin is nothing. I think energy is cheap, natural gas, oil is cheap, agricultural commodities. But I'm bullish pretty much on the whole complex of commodities. They're all going to be bid higher with all this inflation. And especially, as the dollar really tanks, if emerging markets are a main beneficiary of a weaker dollar, then they're going to consume a lot more commodities because, they're going to start consuming more of their own production. Instead of exporting stuff to America, they're going to build stuff and keep it. But I think there's going to be a lot more energy because they're going to produce a lot of things that are more energy and resource intensive when they're no longer just exporting trinkets to America. They're producing goods for their own consumers. So, we could see a real boom in commodities. And of course, this means that commodities are going to be a lot more expensive for Americans too. Just a lot of Americans won't be able to afford to buy them. They'll be priced out of the market.
Central banks record gold buying, weakening U.S. dollar returns, and the outperformance of foreign equities and commodities all point toward a structural shift in global capital flows. Gold and silver miners, alongside emerging markets, are increasingly attracting attention as U.S. assets lose appeal. With inflation, tariffs, and geopolitical realignments reshaping trade and reserve strategies, the next few years could mark a turning point where hard assets and non-U.S. markets take the lead. Could central bank demand alone be enough to push gold toward the $10,000 target? How will the shift of capital into emerging markets and commodities affect long-term U.S. economic influence? Share your thoughts in the comments below. We'd love to hear your perspective. Don't forget to subscribe for future updates, and if you found this content valuable, a thumbs up would be greatly appreciated. Thanks for being part of this journey with us.
I think we've got another 5 to 10 years in gold.
Best, the currency we have up today is going to last another decade. And I mean, at best, I really don't think it's going to last that long at all. So whilst we're still in the currency system we're in, I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be. And at that point, we'll start with a new currency of some description or restrictions of what you can do with your old currency. And at that point, we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
Gold and silver remain in a long-term bull market, driven by central bank buying, ETF accumulation, and rising debt that prompts investors to seek inflation hedges. While gold still has another 5 to 10 years left in its bull market, analysts like Mario Innaco and Clive Thompson believe prices will continue to climb until a major crisis, whether driven by monetary, geopolitical, or systemic forces, forces a reset into a new currency system. Until then, market sentiment suggests continued gains and a potential final explosive rally within the next decade. The speaker, Mario Innaco, a financial market expert, mentions that Bert Dohmen, founder of Dohmen Capital, conducted a long-term cycle study of gold reaching back centuries. He identified a 20-year bear market that started in 1980, which ended around 2000, followed by a secular 30-year bull market that began in 2001. Based on this, he believes the current gold bull could continue through 2030 to 2031. The narrative of a prolonged upward trend amid systemic financial pressures finds strong consensus among many observers. Based on this, it is concluded that gold still has another 5 to 10 years remaining in its bull market. Clive Thompson notes that the bull market in precious metals is likely to continue until a new dollar, pound, or gold-backed currency, or a central bank digital currency, replaces the current currency system. Until then, rising government debt and recurring monetary, bond, or geopolitical crises will continue to drive investors toward inflation hedges. The excerpts from the interview are now available. Please click the bell symbol to receive timely updates, and subscribe to our channel before we continue our conversation. Thank you, and have fun watching the video.
I think we've got another 5 to 10 years in gold. So yeah, in the commodities bull market. Why do I say that? Well, I listened to Bert Doman. He's a fund manager, and I think he started out in the 70s. He's originally from Germany, but he's US based. And he said that in the 70s, he got his clients into gold in the mid-late 70s, and they did very well. And then in 1980, he told them, you need to get out of gold. We're going to have a 20-year bear market. And everyone thought he was crazy, but he was right. And then he said, but after that, there will be a 32-year bull market. And I think he looked at the price of gold going back a few hundred years in the UK, because the UK and the US are linked, the prices. So if you add 32 to 2000, you get 2032, and that's why I'm looking for another 5 years at least. But I think Jim Sinclair used to say that the next move higher in gold, let's say, it's not going to be like in 1980, because we went up to like almost 900, and then the next 20 years we drifted between 250 and 400. He thinks it's going to stay up there next time. It's going to be different. So I'll let Clive answer that.
Well, I think the bull market, if you like, if we could call it bull market in precious metals, continues until such time as the currency has to be replaced by sound money. So how long does it continue? I think at best, the currency we have up today is going to last another decade. And I mean, at best, I really don't think it's going to last that long at all. So whilst we're still in the currency system we're in, I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be, or it'll be some external crisis, whether it be war or civil war or some event that we're not expecting, some black swan event. But these things come along and they'll be pushed into a situation where people are running to the shops to get anything which will preserve its value. And at that point, we'll start with a new currency of some description, or restrictions of what you can do with your old currency. And at that point, we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher, because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
Rafi, in the interview with Clive and Mario, recalls that the gold to CRB ratio indicates gold's value relative to other commodities. Since 2000, it has been in a clear bull trend, despite occasional pullbacks. The 2020 oil crash, when prices briefly went negative, sent the ratio into an extreme spike. However, since gold and silver bottomed in 2022, the ratio has been climbing again. Currently, the chart suggests we're halfway through this significant upswing. Unlike during the lockdowns, oil and other commodities are not depressed. Yet, gold is still rising strongly, indicating solid momentum in its ongoing bull market. However, Mario, along with Clive Thompson, notes that with the global adoption of Basel III capital rules now underway in the US, allocated physical gold is formally recognized as a Tier 1 asset, on par with cash and treasuries. This institutional shift underpins the demand for gold, reinforcing its status as a financial backstop amid potential changes to the monetary regime. Governments are rapidly developing central bank digital currencies. The EU is fast-tracking its digital euro proposal to counter the growing dominance of US-linked stablecoins, while China is expanding international use of its e-Chinese yuan and considering yuan-backed stablecoins for cross-border trade. The UK is also developing a digital pound, with consumer usage expected in the late 2020s. Now, let's have an insight into the interview.
So this is the gold to CRB ratio. All right, so it goes back all the way to 2000, but I picked 2010 here just so you could see.
Yeah.
This is if we're in a gold bull market, then this is the value of gold in terms of other commodities. The higher it is, the higher the gold value is relative to other commodities. So, and we've been in a bull market since 2000, but there've been major pullbacks. Right, this is 2022 when gold and silver bottomed. I think silver bottomed at like $16 or something like that, maybe a little bit more. And we've been climbing ever since then. This was the lockdowns when oil went to negative 35, so that's why it went so high here. But like we're about halfway up this spike when the lockdowns happened, when oil went to negative. So if we're about halfway up this major spike, which was an all-time high, and other oil is not anywhere near negative now because the economy isn't shut down. So gold is it's going pretty fast now.
Well, we do take long-term mortgages, but the rates are set short-term, like 2 and 5 years. So they are based on the like 2-year swap rate, they call it, and the 5-year. But I think long-term rates, they've been going up a lot. They're making like highs, 27-year highs, like the 10-year, the 30-year yield. And what that will do is that's going to hurt the government. That's going to increase the deficit. That's going to inflate things even more. And I think the Bank of England is going to have a tough time cutting the short-term rate. So even though in the UK we don't use the 10 and 30-year rates to set mortgages, I think things are going to remain tough. Clive?
Well, banks, when they lend money for a mortgage, whether it's in the UK or any other country, they are effectively lending that money out for the next 20 or 30 years because they're not realistically expecting anyone to repay the mortgage in the next 6 months. So of course, long-term rates have to have an effect on the interest rate they're going to charge you on the mortgage. Yes, there's an influence in the UK because they set the rate in some way to the 2 or 6 or 5 year term, and then it gets rolled over at a higher rate regularly. But at the end of the day, if long rates are pushing higher, the banks have got to have their heads screwed on and say, well, we've got to charge our customers a little bit more, because at the end of the day, the alternative, we don't have to lend the customers the money on their mortgage. We could go and put the money into a 30-year bond, which is effectively the same thing, instead of lending it to my customer. So if the 30-year bond rates were to go to, say, 7%, you won't be able to, I don't think you'll be able to get a mortgage for less than 7, for sure.
Rafi, you got an opinion on that?
Yeah, so what Clive is saying makes logical sense. If a bank can lend the money to the government with much less risk than it can lend to somebody for a mortgage, with a much lower default risk to the government, obviously, then whether 30-year mortgage rates officially set mortgages or unofficially doesn't make that much of a difference. It makes a little bit of a difference, maybe in short-term fluctuations and stuff, but there shouldn't be too much of a spread between 30. I mean, there shouldn't be more 30-year mortgage rates shouldn't be substantially lower than 30-year bond rates. It shouldn't be lower at all. But if it is lower, it shouldn't be that. It definitely shouldn't be that much lower. So yeah, their mortgages are set by long-term rates, either formally or informally.
Gold and silver remain firmly in a long-term bull market supported by systemic pressures, central bank accumulation, and the institutional recognition of gold as a Tier 1 asset. With CBDCs on the horizon and financial uncertainty growing, precious metals are positioned not only as hedges but as anchors in a shifting monetary system. Meanwhile, miners' renewed strength suggests the bull market is still in its early phase, with significant upside potential if gold prices hold above current levels. Do you think the rise of CBDCs will accelerate demand for physical gold as a parallel store of value? Could gold miners finally see a sustained re-rating, or will they continue to be a niche play despite strong fundamentals? Please feel free to express your opinions in the comments section below. If you found this helpful content, please remember to subscribe to remain updated and to give it a thumbs up. Thank you for joining us on this journey.